Hi, everyone. Welcome back to Capital Consumption Theory. Today, we're here with Brian Winters, and we will be talking about assets and, if we have time, about Bitcoin. But first, I wanted to start off the episode by mentioning one of the conclusions that I forgot to get to on the last episode about currency. And we were, one of the things that we talked about, I think, is how it's a lot of people will say that private banks create most of the money in the economy. And I think if you listen to the episode and think about how these work, there there is a sense in which that is true, but CCT would take a different framing of it and see what the banks do as basically an increase in the velocity of money. But there's a sense which it definitely is not true. And so if you were to sort of naively say that banks create money, I think some people would have the confusion, would have the impression that banks, for example, if they wanted to spend some money, that they have like a private bank sort of money printer in the back, where anytime they want money to spend, they can just create money. And I think the analysis that we did last episode shows why that is not true, because the money that banks create is just an IOU of the bank. It is a declaration that I owe you. So, for example, when the bank gives you a loan for a mortgage for $100,000, they'll have you sign papers saying that you'll pay it back over time, and then they will create an account for you and put $100,000 into that account. What they're doing when they do that is they are just declaring that I owe you, Brian Winters, $100,000. I've loaned you money, and you've actually loaned it back to me by having it in the bank account. So what the banks are able to do is they do time arbitrage, where they can lend the money for long term and get an interest rate on that loan. But when you lend the money to the bank by putting the money in the bank account, that's free. They don't really pay you interest for that. But on the other hand, what they cannot do is they cannot just say, I can create money so I can go and spend it. So if banks, so it's like, when, on our CCT episode, my favorite thing to do is to, give Brian Winters like IOUs, Eddie Chu IOUs, for nothing. If the bank were to, sort of like create private bank money into people's accounts for nothing, or even if they were using it to buy services and goods, that is their liability that they've created. If you go into the account and you say, I want to withdraw that cash, then they have to give you the cash. And so on their balance sheet, if they're not lending that money out and creating an opposite loan agreement where Brian Winters owes the bank $100,000 over time, in that situation, then you are, the bank is adding an asset on their balance sheet, the 100,000 that Brian owes them, and then they're also creating a liability where the money that they gave Brian is just an IOU in the bank account, where Brian now has $100,000 in his bank account. But if they're just spending the money on services, then there's no corresponding asset that gets created there, and they are only adding liabilities to their balance sheet. So on their profit and loss, they would actually show a expense, just like anybody else would. Like if they spend $100,000 on, say, like cushy lounge chairs and massage services for all their employees, that would be an expense. And if they have too many expenses, then that they would generate a loss on their sheet. So they do create money in some sense, which is, not base money, but it is, IOUs for money, promises of money, just like anybody else can, but they cannot actually create money to just spend it.
Well,
So
but like when they give politicians like sweetheart loans and stuff like that, right? And I
yeah,
mean, isn't there essentially just giving people money to spend? Right? Isn't this how like Jeff Bezos and them, they don't, instead of paying taxes on income, they just create loans and spend the loans with the expectation that someday when they're dead, it'll all get paid back. Um, but because the loans aren't income, they don't have to pay taxes on it. Isn't that how it
right.
works?
Well, Jeff Bezos is not a bank. So what Jeff Bezos creates, we will get that to that in this episode, because that is an asset. Even though it's not bank money, it's not part of the money supply what he creates. We'll actually get to that. Um, Now, if the bank were to say, I'm gonna just open an account and give a certain politician $1 million or something, they certainly could do that, but it would definitely be an expense. Like, it would show up on the profit and loss, that they had this $100,000 expense, which is on the balance sheet as an increase in liabilities, and then on the profit and loss it's an expense. And maybe they would say that this is, they might disguise the expense, but the expense would definitely be there. Yeah.
Okay.
Yeah. So to get into assets and Bitcoin, and maybe we can talk about Jeff Bezos. Jeff Bezos and the Amazon thing, that is really interesting, because the way public companies and the stocks of public companies used to work, um, was that dividends used to be a larger part of the picture. And so, theoretically, the stock, you would buy a stock, which is ownership of the company. The company would make money, and then theoretically, some of it they would reinvest, but some of it the rest they would send back to their shareholders, perhaps as dividends. Um, Amazon and the growth companies are really interesting in the current era, because interest rates have come down so much that they've figured out basically that they don't even have to make profits on their balance sheets, on their accounts. Amazon, since it went public, I want to say around in the late '90s, until now, and you look at the entire history, they make very little profits every single year. They spend most of their money. They spend almost all of the money that they bring in on marketing and on growing the company. And so the company continues to grow, continues to grow. It actually doesn't bring very much profits in, and so it doesn't actually have to pay very much taxes, because taxes are calculated on profits. But on the other hand, because the company, when you do a discounted cash flow analysis on the company, theoretically, sometime in the future, they could stop spending all of their profits, and they could actually make some profits if they wanted to, just by cutting back on marketing expenses. And so they have this like theoretical evaluation, which is based on like some future cash flow, which they just always keep pushing into the future. So it's never in the present. They don't have to pay taxes on it. But because they do have revenues, and they really do have the ability, if they wanted to turn some of those revenues into profits, the stock market values them at a certain level. And so the stock price keeps going up, and people who own the stock, they can make money by selling the stock. Jeff Bezos, if he needs some money, he can sell his stock. So you have this enormous asset with a very large valuation, and there's almost no profit for it to be based on, and that's possible
So
because
would a value added tax be a better way to capture some of the benefits that
yeah,
they're creating?
yeah. A value added tax would stop would close that loophole because they do have to make revenues, and so value added tax would come straight out of the revenues of things that they sell. That would close that loophole. The other thing that would sort of make this system a little bit better functioning than it is today is if we ended the capital consumption imbalance and funded more spending in the economy so that more investment is required to keep up with all of the demand. That would pull capital out of financial markets. Interest rates would go up, and as a result, when people in the finance industry, when people like Warren Buffett or the entire finance industry, they do discounted cash flow analyses. When they do that, they will compare the cash flows to the interest rate that they could get by say by investing in a 10-year treasury bond. So right now that treasury yield that they're using is around 1%, and in the last 3 months, the level of inflation for the last 3 months has been like 5%, and even prior to that, it's always been even prior to that, it was greater than 1%. So real interest rates right now are actually negative. So when you plug that into a discounted cash flow analysis, theoretically, the valuation is theoretically infinite when you're dividing by zero. If you compare like what pricing of this stock, where the cash flows can grow in the future, when you're comparing that to a bond yield, which is a negative real rate, then you get an infinite number in terms of how valuable that is. Warren Buffett, I think last year or the year before, was also saying, if you look at the stock market, the valuations are super high, but if you compare it to what the 10-year treasury yields, Buffett figures that you're still better off being in the market than investing in treasury bonds. Yeah, because in real terms, if you buy a 10-year treasury bond right now, in 10 years you'll have less money than when you invested into the.
You'll have more money but less purchasing power.
Yeah, you'll have more money but less purchasing power. Yeah, correct. So assets is what we're talking about. So assets. So the interesting thing about assets is that they are, if you think about that Amazon example, these assets, and people who do kind of work in the finance industry or something like that, or think about stocks a lot, they see this on a yearly basis, on a monthly basis. You have this asset which fluctuates which goes up and down in value, and it's worth 100 billion more or 100 billion less, and it is completely determined simply by market consensus. It is simply a market consensus that Amazon is worth that much, and it is simply because in the market for trading Amazon stock, when you line up all the people who want to sell Amazon stock today and all the people who want to buy Amazon stock today, and you have this bidding mechanism where people can offer bids and say, I'm willing to sell for how much, I'm willing to buy for how much, and you just match up the buyers and the sellers. The supply and demand of that results in the outcome of the price being at a certain level. It's all just market consensus. Now, market consensus is it is somewhat stable. There are factors which make it relatively stable and relatively rational. Relatively sort of the close to the most reasonable price that you can have, and the reason you have that is that you're it's just like every other market mechanism. Everybody is trying to sort of maximize their profits and minimize their losses. And in financial markets, the way you do that, if you want to make more profit and not have a loss, then you have to buy an asset when the price is lower and sell it when it's higher. And there's a lot of ways to do that. There's everything from very short term to very long term. But generally speaking, the actions of traders and investors are incentivized to where everybody wants to buy lower and sell higher. So if you look at what the supply demand of that does, when you're buying an asset, then you're going to tend to drive the price upwards. When you're selling it, you tend to drive the price downwards. So everybody is sort of just doing their very best to sell it when it's too high and drive the price down, and buy it when it's too low and drive the price up. And so that ends up with a price which is by the consensus of people who sort of put money on their opinions, who basically bet money on their opinions. It's like a betting market. It's everybody who's willing to bet money on the market, their best opinion about what it should be worth, and that's where the market ends up. We were talking about currency on the last episode. And next to currency, you have liabilities or debt, which sometimes looks a little bit like currency. So those two things are sort of, there's sort of some gray area between the two things. Debt. Debt is also an asset. So debt is a liability for the borrower. It's an asset for the lender. Another way of looking at it is that debt actually gets like bought and sold. Like people will buy those IOUs. So, for example, when a corporation issues bonds, when it wants to have some cash to invest, and it issues bonds into the bond market, it sells those bonds to investors, and then investors buy the bonds. Those corporate bonds they work the same way as treasury bonds. So they come out with, say, Amazon, if it were to issue a bond, it would come out with, say, this is a 10-year bond, it pays 5% or 7% or whatever. And then investors would buy it. And there's an interesting phenomenon that goes on, which links the sort of debt concepts to the asset concepts, which is that sometimes a corporation or company will get into trouble, and there will be a risk that sometime in the future, if this company is doing really badly, it may actually go out of business. It may go bankrupt, and when it does, it may actually not have enough money to pay back those bonds. And so you end up with a market price for these corporate bonds. And if the company is distressed, the market price will actually go down. So nominally the bond may pay like 7%, but it may sell at a discount of, say, 50%. So the discount of 50% means that if you buy the bond and the company doesn't go under, then you make a lot of money. But if you buy it and the company does go under, then you lose your money. So you have
when you say it sells at 50%, so does that mean essentially you'd be making 14% instead of 7% if it doesn't go bankrupt?
Roughly. It's actually a little bit more complicated than that, because you also have the capital payment at the very end of the bond.
Okay.
But yeah, you can
Yep.
actually calculate based on the payments and the capital payment. But then you would, like, as a mathematician, you would apply a probability function to this. Like, I have, maybe 50% that it all gets paid back with the interest. And like, say it's a $10,000 bond. I only paid $5,000 for it, because that's what the market is paying for it right now. I only pay 5,000 for it. And so I get 14% interest payments, on my $5,000. And then if the company does not go under, then at the end of the 10 years, they actually pay me back the nominal figure. So I actually get $10,000 at the end. So if I manage to do that correctly, I can make lots of money on that $5,000. If I do it
Okay.
wrong, it goes bankrupt and I lose the 5,000. Maybe
And
they
so
make two.
the other question is where does paying off debts to bondholders, where does that fall in the bankruptcy scale?
So it comes before equity holders. So usually if the company goes bankrupt, the equity shareholders, they're wiped out. It gets, they get nothing. The corporation, if it goes bankrupt and it actually stops operating, then it would take all of the factories, all of the physical assets that the company owns, which is all recorded on the finances, on the balance sheet. They would sell everything off, and then they would take that money and they would split it up among the bondholders. And so the bondholders might get like a small portion of their money back, but usually if the company goes bankrupt, then they will take a loss, because those assets which are on the books may be at the price which the company bought the physical asset for, but when they go and sell it, they're not actually going to be able to get that much money for it. It's like when you have a car or a laptop or something, and
Okay.
go to use, you're never going to.
Okay. And then to go back to the 7% versus 14%. So if
Yeah.
it's a $10,000 bond that pays 7%, but you buy it for 5,000, you're earning 7% on the $10,000 face value. Is
That
that
is correct.
okay?
That's what
Right.
company
That's how you
has
kind
agreed
of get the double the okay. All
for the
right.
bond. So that's how you get the 14%. And
Okay.
then if they pay it back, then you get 10,000. So it's a great deal if you manage to do that correctly.
Okay.
But you have to take a risk in order to do that. But by looking at the corporate bond and the way that liability can actually, the price of the liability can actually go up and down in the market. Again, that brings it back into the realm of, this is something which is, the value of it just fluctuates based on market consensus. And there's a lot of things in the economy that work this way. There is, like, there's I think there's a sort of a draw, like for most economists, they try to uh, be sort of very scientific and objective. So they don't tend to talk about these things. They tend to talk more about things that they can speak more concretely about. But if you talk to people who are in finance, and think about things that go on in finance, then it becomes clear to you that everything just floats with consensus. And the financial sector of the economy and the entire economy as a whole, is not sort of, driven by these hard mechanisms. A great deal of it is actually stable because of market consensus. So I would include things like inflation and deflation. All of that is simply driven by individual companies and individuals, setting up prices and accepting the prices, or not accepting the prices. It's all market consensus. And you also have things where that plugs into activity.
So,
Such as one example would be like the paradox of thrift, the Keynesian products paradox of thrift, where if everybody is sort of confident in the economy going forward, then they spend money. But then if people become anxious, then all of a sudden everybody stops spending money. And there's also self-reinforcing feedback loops there, where if you're a customer.
I think we're kind of losing you, Eddie.
Stop spending money, or the company that hires you stops spending money and decides to lay you.
All right, Eddie. I don't know if you can still hear me, but can we go back to something you said a minute ago about, I think you said market prices were sort of based on consensus. And I guess I'm trying to figure out how that works in. All right, so welcome back, Eddie. So I was trying to go back to something that you said a minute ago. I think it was you're saying how market prices were sort of set by consensus.
Yes.
And I was wondering, like, how does that work in cases of things like insulin, where one company can just decide to jack up the price? What consensus is agreeing to charging people more for their life-saving medicine?
Yeah. So that's definitely sort of a market failure. That's definitely something where you want to consider more than just the market. So that so insulin, life-saving medicine. That is a type of market, but it is not a sort of a fair market. It's almost like as if someone kidnapped your daughter and said, I will release her, but you have to pay $dollars. That is also a very small market, but it's definitely not a fair market. You would be willing to pay the money, potentially, because you want your daughter released. But there's a consequence there, which is not it's not a normal consequence. It's not like do you want to eat this hamburger or not? Like you can choose not to eat the hamburger and go eat a taco instead. You can't really, choose to just I don't feel like having insulin.
Yeah.
Right.
But there are a lot of markets like that, like the housing market or the rental market, right? Where you can decide, well, I can pay my landlord's 50% increase in rent, or I can decide to live under a bridge.
Yeah.
That's not necessarily a so where's the consensus there?
The housing
Setting the
market,
market price.
because there's actually relatively a lot of landlords to choose from, and so you can choose to go if this landlord is trying to charge too much for the housing, you can go to another landlord. But on the other hand, the problems that we have is that the market price itself for housing is too high, and I would argue that has a lot to do with um, I forget if we talked about this or just when we were chatting beforehand, but one of the only avenues for easy finance with low interest rates that consumers have access to is the mortgage, and the other one is education. And so if you look at the markets for those two things, those are the two big things that the price has just gone sky high, and that is a market mechanism that occurs because you know, you can access that money cheaply, and so as a result, um, you know, you're sort of uh, you know, you're sort of supercharging demand, and allowing the prices to go way up, because the borrowers find that with the low interest payments, you know, it does make sense to them personally to buy a house, or to buy an education. You know, but in the market, you know, the price just goes crazy, because you know, that's the only place where you can get, you know, almost free money. You know, for anything else, you'd have to pay 10% or 20%. If you want to start a small business and you ask the bank for a loan, that's 10%. As for a mortgage, you know, it's 2 or 3%. So that's a big difference, and that definitely drives prices. And it's definitely you know, also an aspect of capital consumption imbalance, where you have, um, you know, you have the money, which is the Federal Reserve is creating, is going into debt markets, and those are the outlets, and those, so they drive those specific prices up, but the money is not going to the consumer, where it should be going, to allow the consumer to, you know, purchase the, you know, products of the economy which they want and need.
And so the third category with skyrocketing prices is healthcare expenses, healthcare costs, right? But that doesn't come from the same cheap money, does it?
Not so much, I don't think.
That's
And
the
I'm
market
not,
consensus setting prices again?
well, I'm not an expert on healthcare industry, um,
Me neither.
but you know, I think that, I mean, one of the interesting things about the healthcare industry is that, um, you know, the pharmaceutical companies, they invest into creating a drug, and then they sell it. They sell it all over the world. And the interesting thing is that, you know, every single other country has, you know, public health care, and so, you know, in every other country, they're dealing with, the government or the country as a whole. And so that's, you know, very powerful negotiating power for that country. If they say, you know, I'm going to use your drug, or I'm going to use, another company's drug, there's a lot of incentive for pharmaceutical companies to give them a very reasonable price. But on the other hand, in, you know, the U.S., you know, works a different way. Um, and pharmaceutical companies, you know, in trying to maximize their their business, you know, the system in the US allows them to charge really high prices. And what they actually do is they actually, make all their profits in the US, and then everybody else in the world, you know, gets the same stuff, for much lower prices. And the US is, you know, if basically subsidizes, the healthcare of the rest of the world, you know, because we're the ones that are, you know, we're the silly buyers in the room, the ones that are just, you know, individually not willing, but, you know, as a collective, we are somehow willing, or, you know, unable to not be willing to just pay these high prices to the companies. Yeah.
Okay. So assets.
It's our job as the buyer to ask for a lower price, but we're, you know, we're seeming unable to do that, and we do pay the price for that. Yeah.
All right. So assets.
Um, so one of the interesting things, again, you know, from CCT view, is that, you know, with the capital consumption imbalance, and with the monetary stimulus of the Federal Reserve, having been designed only to go into debt markets, and with really corporations being the ones that can, actually access those debt markets, you know, based on those low interest rates. Banks especially, and to some degree other corporations, can access that low interest rate financing. You know, you end up driving really high. And the thing about the current economy, especially, you know, sort of this year, the last 2 years, is that, you know, as a continuation of, you know, you're basically holding up the economy by the wealth effect. And so you're, again, the assets themselves, you know, the prices can go up and or down in the marketplace. And when they do that, you have this huge sort of financial value creation or value destruction. And right now, the entire economy is held up by these asset bubbles. And so, you know, the worker consumer in general does not have enough income coming to them to really, you know, actually have the economy grow in a healthy way. But one of the ways that people, sort of the middle class, upper middle class, and the wealthy, you know, receive, you know, money to which they can then turn around and spend it and drive the economy, is by this asset, you know, this financial asset value creation, which is driven by low interest rates. And so you get into a situation where, you know, the assets, like there is a lot of agreement among the financial industry, I'd say by majority, that asset prices are too high. And so you have this instability that when, if or when, you know, that bubble, those prices start crashing, start coming down, then it drives a very strong self-reinforcing loop where, you know, when the asset prices, like everything looks great when the S&P is at 4,500, and then when that price, you know, crashes, then everybody, like in the middle and upper middle class and the wealthy, felt like they had money before the crash, and then after the crash, suddenly everybody feels like they don't have money, and in a very real sense, that they're right. They don't have money. They used to have, you know, $100,000 portfolio, and then after the crash, they have a $50,000 portfolio. Or if they were leveraged, maybe they go from having $100,000 to maybe they only have 30,000 or 20,000 or even worse after the crash. So it's a little bit similar to in the last, you know, episode where we talked about bank runs and how, you know, in a healthy economy, the banking system is stable. But if you get something like in the Great Depression where you had bank runs and everybody get their money out of the bank, suddenly that money just disappeared, and assets, you know, do the same thing. And the disappearance of those assets will definitely cause the real activity of the economy to actually go down. So this is what I meant when I said last week that the economy is run on trust. You know, and it is not, you know, it is not this sort of very determinate system where, you know, if you add $100 billion, if you have, you know, $17.2 trillion in money supply, then the economy will do this. If you have, you know, 16.2, then it'll do that. You know, 19.2, it'll do that. That's sort of how the Fed sort of thinks about it a little bit. But in actuality, you really have to look at the whole thing, and you have to look at the dynamic reaction to what happens, such as, you know, this reaction where, you know, confusingly to some people, the economy seems to be doing quite well right now, because the stock market is doing quite well. But, you know, you have to keep in mind, you don't want to be surprised and suddenly the stock market crashes, and then the economic activity crashes, and that just makes the stock market, you know, crash even more if you know, if you don't have activity and businesses are losing money because the revenues have gone way down due to the stock market crash and the depression. The other thing which is held up by market consensus is the US dollar itself. that is also a market consensus, and it's a very special one, and it is a relatively stable market consensus because everybody's salaries, everything that you buy, everything in the financial markets, the entire economic system is held together by that one point, like that a dollar is worth a dollar. But one of the risks here is that you are injecting very large amounts of dollars into the system, and you're injecting them in the wrong place. You're injecting them at the top, which already has too much of that stimulus, is already too inflated. The assets are too inflated. And one of the worst case scenarios is where the finance investors and the investors start looking around and saying, this is craziness. I do not want to put more dollars into these super overvalued stocks. And they start looking around, and there is a narrative that is relatively strong, among investors about doubt about the future of the dollar. And so if the investors are worried about the dollar and they say, okay, I don't want to hold lots of dollars, I don't want stocks either, what do? They go and buy real estate. And so real estate is up I think 15% this year. Rents are up 10%. They buy gold, they buy Bitcoin, they buy commodities. And this goes back to George Soros's concept of reflexivity, where the economy and the financial markets are different than other, say, hard sciences, because you have this loop where the narrative is hard tracks. The narrative is almost like a fact. So if you have a rocket, if you're sending a rocket to the moon, and it generates a certain amount of force through its engines, then then it's going to have a certain trajectory. And it does not matter what the rocket thinks. It does not matter what you think about the rocket. The rocket is only going to react to the force coming out of the end of its engine. But in financial markets, facts change due to narratives. So if the narrative is building that people don't want to be in the US dollar, and they sell their dollars for gold, Bitcoin, and especially for things like commodities, where they say, I'm going to invest in commodities. I believe that the price that commodities will go up relative to the dollar. Then there is a self-reinforcing, self-action loop there, where investors buying commodities will actually drive up costs, and it will actually cause prices to rise. It will actually cause the inflation that was expected. That's something that you have to keep in mind. People will sometimes say, well, just don't think that. Which, if you had a magic wand and you could change everybody's mind at an instant, then maybe that would work. But given that nobody has that magic wand, that doesn't work. The narrative is you can't just control it that easily. People will think what they think based on their read of the facts. And so what you really want to do is to change the facts themselves. Those are more, you can work with those more easily, especially if you're the Federal Reserve, if you're the U.S. government, and you say, we are going to institute a monetary UBI. People are going to have money. Then the very real, outcome of that is that people will go out and spend the money. Businesses will have to invest in order to keep up with that demand. And the Federal Reserve can also, withdraw interest rate policy. So with all of that capital coming out of the asset markets, that will actually, either deflate the asset bubble, or it will actually reify the asset bubble, where it allows people to spend money in the real economy, and the economy to actually grow to the point where the asset prices actually start making some sense again.
So by using universal basic income to grow the money supply at the bottom, And so it trickles up as opposed to what we're doing now where it's top down. Like, what are the other ramifications? Is that going to cause inflation?
Um, it will, if you look at the period between 1940s and the 1970s, that is what sort of aiming for. And if you look at that period, you did have some inflation in some periods, but it was not particularly severe. And most importantly, is that the wages and the real income went up. So the prices, you may get some mild inflation, but the real activity will actually go up, so that even though you have some inflation, but you also have real income growth. That's what you want to aim for. And the price going up, that will, sort of as, that will allow the market for different products and services, that will allow the economy to sort of readjust itself to the new paradigm. But if you're setting it in at the bottom, then you're right shaping the money supply and the economy, and it would be a good result in the end. And you would cut off the possibility of like severe hyperinflation, because severe hyperinflation is a situation where you have a lot of capital consumption balance, and that inflationary top, that's when the top kind of bursts, and you get the currency collapses, and the economic activity also goes down um, within that dynamic. You don't want to have that, and that's why you want to have monetary UBI. That would prevent that by pulling the capital out of the top, where it is currently like overinflated.
Sorry, can you repeat that? So how does monetary UBI, how does that prevent hyperinflation?
So hyperinflation occurs because, when you have too much capital at the top and it has no productive outlet, because businesses, they can't build more factories because consumers don't have money to buy the products, then instead it turns into the speculative bubble. And you see that in writings about, the Weimar Republic, for instance,
Okay.
where you
And so when you say capital at the top, you mean fiat currency. Is that what you mean by capital?
when I say capital at the top, I mean how much capital do wealthy people have? Capitalists, do wealthy people have the top 1%, the top 5%? The Weimar Germany situation was similar to our situation, where you had very high wealth inequality. And when you have high wealth inequality and the consumer worker at the bottom does not have money to spend on the economy, then that capital becomes stagnant, idle capital that has nothing productive to do. And so it just goes into asset bubbles. They just, people will buy asset bubbles, but then at some point the asset bubble may crash, but they don't want to be in the currency. And so they go into other currencies, they go into gold. Right now, people are going into Bitcoin. And another aspect of it is that in hyperinflation, it's almost sort of like a extreme stagflation, where because faith is being lost in the currency, and loss of faith drives down the price of the currency. What has happens is that businesses, they are actually reluctant to invest into real production, as a response. Like in a normal, healthy economy, when the price goes up, then businesses rush in and say, "Hey, this is a great product to sell. Let's make lots of this product," which stabilizes it. It keeps the price from going up too much. But in hyperinflation, what's happening is that the businesses have lost faith in the currency, and so when the price goes up, they don't say, "Oh, let's go make lots of this product." They say, who knows what's going to happen there, but if I have any, then I'm going to put my prices up, but I'm not going to go and sort of invest into making more of it, because the whole situation is too unstable. You have sort of like a glimmer of that. There was a tweet that I saw earlier today about how shipping companies are not investing into more capacity. And the reason they're not doing that is because they figure that the stimulus money is temporary, which, you know, currently it is temporary. And so if the spending is temporary, then they don't want to invest in a ship which they're going to, which, you know, they're thinking maybe for the next 20 or 30 years it will be really underused. So they don't invest into more capacity, and they just allow the prices to rise. And that is a little bit of that you know, dynamic, you know, loss of faith, a little bit of that loss of faith dynamic, which is a little bit bad and a little bit dangerous. That if it continues to worsen, and if we don't get UBI, that is you know, one of the dynamics that has the price rise stably, and you lose that stabilizing mechanism. A normal healthy market would have production go up, and then the price would stop rising. But if you don't have that faith in the economy and the currency and the future, then you get prices that, you know, keep on going. So hopefully that doesn't happen. You know, everybody listening should work very hard to tell everybody we need UBI. UBI will stabilize the economy, and without UBI, the current path of the economy is unsustainable. You either get you know, inflationary action, or you get you know, depression, because, you know, the economy is wrong shaped. Inflation at the top, deflation at the bottom. I think that's all that we have time for today. But so thanks everyone for listening. And you know, we're opening up this capital consumption theory discussion. So in 2 weeks from now, which is on October 15th, welcome everyone to send me a DM on Twitter, and I'll send you a link, and, you know, join in the discussion. Thanks. See you guys.
And I'm going to say October 15th, depending on what time zone you're in. If you're in Eastern Standard Time, it'll still be October 14th.
That's right. So October 14th, 10 p.m. Eastern Standard Time in the year. Yeah, I'm interested.
Right. Look forward to talking with you again then, Eddie.
Okay,
Have a good night.